Today's lecture is about the efficiency and inefficiency of financial markets. And by that, I mean the extent to which asset prices will diverge from their fundamental values. So what do we mean by market efficiency? So markets are efficient with respect to a given information set if all the information contained in this information set is incorporated into market prices at time t. So in other words, market prices reflect all this information. Okay. So of course, it depends on what information we are considering. And so there are three types of market efficiency. The first type is weak efficiency. If the information set in question is all past, all historical asset prices. Okay, so in this case, market prices should incorporate the information contained in previous asset prices. Semi-strong form efficiency is when the information considered is all public information. So in this case, asset prices should reflect all publicly available information. And then there's a strong form efficiency, which is that market prices should incorporate all potentially available information, including private information. So whenever someone knows something, asset prices should incorporate that information. So of course, we cannot directly test this prediction, but this efficient market hypothesis, and so there's three levels of this hypothesis, has some implications. The first one is that if markets are efficient with respect to some information set, then any new information will be immediately integrated into prices. So then you can conduct some event studies to try to figure out if market prices instantaneously adjust to any new information, and if there is any post-announcement drift, which would mean that the incorporation of the information was not immediate or was excessive or insufficient. Another implication is that it is impossible to make excess in excess of the risk-free rate risk adjusted. So of course, if you take risks, you're going to have more profits. But so it's impossible to make excess risk adjusted profits by trading on the basis of some information. So let's consider weak form efficiency. It would mean that it's impossible to make money by trading on the basis of historical asset prices. This is sometimes violated, and indeed has been shown that momentum investment strategies, which consist in buying past winners and shorting past losers, is going to lead to excess profits. Okay, so that would be a violation of a weak form efficiency. Also, any test of stock market efficiency is going to run into the joint hypothesis problem, that you are testing not only that markets are efficient, but you are also testing a particular asset pricing model, right? When you test this implication to calculate this risk adjustment, you're going to use an asset pricing model. But perhaps momentum strategies are profitable because there's some risk that we don't account for, right? So we have to be mindful of that. When you reject market efficiency, you reject at least one of two things: that markets are efficient, or that you are using the correct asset pricing model. So it's a joint hypothesis test. Yeah, before we start, I'm just going to debunk a few myths about stock market efficiency. Sometimes people argue that asset prices fluctuate and therefore markets are inefficient. Well, this is not true. Even a stock market crash is not evidence of market inefficiency, and to the extent that it is unpredictable. If a stock market crash is predictable, for example, on the basis of public information, then that would be a violation of market efficiency. Also, sometimes people argue that it is impossible to predict the stock market, and so that economists fail because they cannot predict the trajectory of the stock market. That's not correct. So here, Ricardo Caballero argues that severe crises are essentially unpredictable. It's almost by definition. If they had been predicted, then they could have been prevented or at least mitigated. Now, if you look at some predictions by economic theory, some of these predictions, we saw that in the Gladstone-Milgrom model, is that prices follow a martingale, right? So the evolution of future prices is unpredictable. So the fact that the stock market is unpredictable is not evidence of market inefficiency. It's actually very consistent with very basic models. Okay. Nevertheless, it seems that markets are sometimes inefficient and sometimes wildly inefficient. So in this lecture, we're going to study the notion of a noise trader risk, the notion that some traders who trade, so to speak, on noise, so their trades are not based on information, these traders may generate some inefficiency in financial markets. So why is that? So in some of what we studied so far, noise traders or liquidity traders, as we call them sometimes, they can play a useful role. So remember in the Kyle model, without liquidity traders, there would be a market breakdown. There would not be any trade on financial markets because the market maker would never want to be on the losing side of the trade when he knows that he's facing traders who are more informed than he is. Okay, so liquidity traders play a very useful role by creating essentially the possibility of market liquidity. Well, yeah, but that may create divergence between market prices and assets' fundamental values. But then there would be some arbitrageurs, some sophisticated investors who would be aware of these discrepancies, and we would trade against them in such a way that they would eliminate this divergence between market prices and their fundamental values. However, the problem is that sometimes all these traders who do not trade based on information, so all of those who trade based on, so to speak, noise, the fact that they do not only trade today, they're also going to trade in the future. And it is the unpredictability of the future demand of noise traders that is creating a risk that is going to deter arbitrages today. Because if you take a position today, you don't know how noise traders are going to behave in the future. And so you're taking a risk if you're going to try to bring prices back in line with fundamentals today. So in other words, arbitrage will not necessarily eliminate the effects of noise today, because noise itself creates risk in the future as well. And this is true if arbitrageurs care about their short-term performance. If arbitrageurs or sophisticated investors could hold a stock for decades, then it would not be such a problem, right? You just buy asset prices that are fundamentally undervalued, you short those that are fundamentally overvalued, and you don't care about short-term fluctuation in asset prices, right? Because you have a very long horizon. However, if you have a short horizon, or if you have limited capital, right, and if you need to borrow to take positions on financial markets, then you're going to have a short horizon. You're going to care about the level of market prices, and you're going to care if market prices are going to move against you in the future. And this can be true for many reasons, because of an agency relationship in portfolio management. So we study that a bit in the Dow and Gorton model. In this case, the performance of asset managers is going to be periodically assessed, and based on their performance, they may get fired or they may lose assets. And so clients will just withdraw their assets from the fund if they have a poor performance. And why is that? Well, it's in part because they will be learning of fund managers' abilities. So if you consistently underperform the market, clients are not going to stick around. And also there's the notion of fund managers' compensation, which might be short-term in such a way that it would distort their horizon towards the short term. And so this type of internal conflict for sophisticated investors, that on the one hand, they would like to bring prices back into line with fundamentals because that's how they can make money based on their superior information. But that on the other hand, they're concerned that prices might move even further against them in the future, was actually at the heart of lots of episodes that provided evidence for stock market inefficiency. And the fact that there was a divergence between market prices and fundamental values. One example is so-called Black Monday, which is a stock market crash in 1987. And in this case, there were some sophisticated investors, right, who might believe that asset prices were undervalued. But in this case, it was arguably very risky for them to trade against the market when the market was collapsing. Another example is the speculative bubble of the late 90s. That was mostly focused on so-called new economy stocks, and stocks of companies that were involved in the information revolution of new technologies in the late 90s, including telecommunications and the internet. The stock price values rose enormously, especially compared to so-called old economy stocks, traditional manufacturers, and so on. But as you can see, then this bubble burst and stock prices collapsed. And so John Maynard Keynes put it beautifully when he said that in principle, so you should invest based on long-term expectation, but he's saying that it's very difficult in practice, right? And if you try to do that, you would run great risk compared to someone who's trying to guess better than the crowd how the crowd will behave. And so here is really contrasting two approaches to investment. The first one is a fundamental approach to investment. You try to assess assets' fundamental values and you take positions accordingly. But he's arguing that it's actually very risky to do that. And also difficult, right? You need to have very good information. The second approach to investment is to try to be one step ahead of the market. You try to guess how market prices are going to move, and you try to benefit from that. But then you're not really bringing prices back into line with fundamentals, right? You may actually exacerbate divergence rather than mitigate them. And this was put in quite colorful language by Jeremy Grantham of GMO. I'd understood in the late 90s that some stock prices were overvalued, right? And so they started to unload all their so-called new economy stocks in 1998 and 1999. And then they lost many clients. They lost lots of assets under management. So from their perspective, it was not great to actually take a position that was justified based on the fundamentals, but in such a way that they took a great risk by betting against the market. More recently, you might have been aware of Tesla's stock price. And as you can see, the stock price was trading in a relatively narrow range here. And at some point, some retail investors, so you can view that as noise traders, starting buying the stock, and the stock price increased, and then it increased even further, right? And so whomever saw that the stock price fundamental value was around here and started short selling the stock around there, for example, made huge losses, right? So it was very risky to trade against these retail investors or noise traders. Another even more recent example is GameStop. You might have heard about that. There was a company that was very close to bankruptcy in early 2021. You look at the stock price, it's very close to zero. And it was also attacked by short sellers. So hedge funds were short selling the stock because they expected the company to go bankrupt and the stock price to be worth zero. Then what happened is that there was an army of retail investors who started buying the stock and taking the stocks to incredible high, right? At this point, the stock price was substantially overvalued. And so if you had been short selling the stock, as many hedge funds did early in 2021, so all these hedge funds had massive losses, right? Even though fundamentally it might have been right, but they took a big risk. They didn't know what the demand from noise traders would be in the future. Okay, so let's try to put more structure on all these ideas, and let's try to build a model to see what would happen and to gain some additional insights into this issue. And for these purposes, so I'm going to study the model of noise trader risk of DeLong, Schleifer, Summers, and Waldman, published in 1990, entitled Noise Trader Risk in Financial Markets. But I'm going to follow the presentation of Dimitri Vayanos from LSE and Jian Wang from MIT. So it's a model with overlapping generations in which agents live for 2 periods. They choose their portfolio in the first period, and then they liquidate their portfolio and they use the proceeds to consume in the second period, T+1. Okay, so why do we do that? The idea that here we create a short horizon for these agents. They don't live for an infinity of periods. They only live for 2 periods, and so they're going to be concerned with market prices, the price at which they will be able to liquidate their assets in the next period, as opposed to a hypothetical fundamental value for these assets. Okay, so they'll be concerned with the price PT+1 of assets. Okay, there's going to be 2 assets. So we keep things as simple as possible. 1 risk-free asset, perfectly elastic supply. You can buy and sell as much as you want with a return R. Okay, so R can be, for example, 2%. Then there's a risky asset whose fundamental value is the same as the risk-free asset, in the sense that it's going to pay a dividend of R each period. So the same return. Its price at time t is denoted by PT. Okay, and so its price might fluctuate. And it is a net supply, capital S, okay, which is positive. So these 2 assets have the same, they have the same payoffs, right? So they should be perfect substitute and have identical prices. So if you normalize the price of the risk-free asset to 1, the return is 2%. So it means that the risk-free asset pays 2 cents in every period. So that would mean that the dividend R here would also be 2 cents in every period, regardless of the price. So in principle, these 2 assets should be perfect substitute, right? They have the same, exactly the same cash flows in every period. But the price of the risk-free asset will be 1 in any case, whereas the price of the risky asset will be PT, which can fluctuate. And so here we're simplifying the model, and we're making it a bit hard to have a divergence in prices, because it is obvious that the risky asset is fundamentally the same thing as the risk-free asset in terms of cash flows. Okay, so who are the investors? There are some noise traders, and here they just submit a demand for assets for the risky asset, which is unpredictable and random. And so their demand is normally distributed with a mean of U bar and a variance of sigma U square. Then there's a number N of sophisticated investors. So these are investors who are going to optimize. They have Cara utility with an absolute risk aversion of alpha. Already you can see that here we assume normal distributions with Cara utility. So that's going to make the portfolio choice problem tractable. Okay, so the payoff of the risky asset is fixed. So it's equal to R in every period, for example, 2 cents in every period, like the risk-free asset. So the only source of uncertainty is the future price of the risky asset. Now there's no uncertainty about the cash flow. You already know the cash flows. So let's consider the optimization problem of sophisticated investors. So as is usual, they maximize the expected utility of their future wealth as a function of their portfolio. And here, what is their portfolio? It is the quantity XT of risky assets that they will purchase. So what is their future wealth? Well, there's 2 assets. So there's 2 components to their future wealth. the first one is the amount that they will invest in the risk-free asset. So for any dollar invested, they will get this dollar back plus the risk-free asset return. And the amount of dollars that they will invest is equal to their wealth at time t minus the amount they will invest in the risky asset, which is the number of risky assets purchased times the price of the risky asset at time t. Okay. The second component of their portfolio is their position in the risky asset. And what is it going to give them at time t plus 1? Well, it's going to give them the number of risky asset purchased times the cash flow of the risky asset, so R, plus the price, the liquidation price of the risky asset, which is PT plus 1. And here, to keep track of what is a random variable and what is not, I use the tilde notation. And so here's the only unknown is the liquidation price PT plus 1 of the risky asset. And of course, XT can be positive or negative. They can take long or short positions. Okay, so we're going to use the standard certainty equivalent approach. And so we're going to maximize the expected wealth, the expected future wealth minus alpha over 2 times the variance of future wealth. And so here, we assume that future wealth is normally distributed because the future price will be normally distributed. Okay, so this is the expectation of future wealth for a given position XT in a risky asset. And this is the variance of future wealth, again, for a given position XT in a risky asset. So this is a standard portfolio choice problem, which is globally concave in XT. And so we know that the optimum will be described by the first order condition. So we take the first order condition, we differentiate all that with respect to XT, and then we solve for XT. And we get that XT is equal to this. So it's quite straightforward, except for these two terms. So here, XT is going to depend on the expectation of the price next period, and it's going to depend on the variance of the price next period. Okay, and this is indeed this term that is going to create risk from the perspective of the sophisticated investors. Okay, so how do we solve this model? So it's a bit similar to the problem we're facing with the Grossman-Stiglitz model, in which to determine the optimal demand, you need to know what the price looks like. And of course, to determine the price, you need to use the optimal demands and to plug them into the market clearing equation. Okay, so how do we get out of this conundrum? What we can do is we simply postulate a linear price function. And so we study linear equilibria in which the price is going to be linear in whichever source of uncertainty there is in the model. Okay, here the only source of uncertainty in the model is the demand from noise traders at any time t. So there's going to be a random demand UT from noise traders for the risky assets. Okay, and so we're going to assume that at any time t, the price is going to be a linear function of this linear demand. So at time t, the price is going to depend on current demand UT from noise traders. And at time t plus 1, the price is going to depend on, again, the current demand, so at time t plus 1 from noise traders. And of course, demand UT from noise traders is only realized at time t. You don't know at time t what UT plus 1 will be. You don't know what noise traders will do next period. I mean, you have some idea, but what they will do, right? They trade with this mean and this variance, but there's still some uncertainty about what they will actually do. Okay, so now we're going to use this, and more specifically, we're going to use this equation because in both cases here, we're interested into the expectation and the variance of the next period price. Let's start with the expectation. So here we're going to take expectations on both sides of this equation. And we find that the expected price next period is equal to A plus B times the expectation of UT plus 1. What is the expectation of UT plus 1? Well, at any point in time, U tilde follows this distribution. So the expectation of UT plus 1 is simply U bar. Okay, let's move on to the variance. So again, we start from this equation. We take the variance on both sides. And so we get the variance of the next period stock price is equal to, so A is a constant. And then so it's equal to the variance of that. Again, B is a constant. So we get B squared times the variance of this random variable. What is it? We get back here, and this is it. Okay, this is what we have. So now we'll be able to plug this into this expression for the risky asset demand from sophisticated investors. And we're going to, in turn, plug this demand into the market clearing equation, which will give us the stock price at time t. So we know the stock price at any time t is given by the market clearing equation at time t as well. And this market clearing equation must be satisfied in any case, meaning for any demand UT emanating from noise traders. The market clearing equation, very standard. We know that the total demand for the asset, so which is equal to the number n of sophisticated investors multiplied by the demand xt of any investor at this point in time, plus the demand from noise traders, must be equal to the total supply of the risky asset, which is time invariant. It's equal to S. Okay, so total demand equal to asset supply. And that's going to give us the asset price at time t. What is xt? Well, we have xt here, and we're going to use these expressions for the expectation and the variance of the next period price. And so if we replace into this equation for xt, and then we insert xt into this market clearing equation, we simply get that. So this is xt. Again, we keep in mind that this must be satisfied for any UT. So here, as you can see, so where does UT show up? It shows up there in the equation. And now what I'm going to do is I'm going to factor in UT. And why is that? So it's the same reasoning as in the Grossman-Stiglitz model. We have one equation, this one market clearing equation. And what we're trying to derive from it are the values of the parameters capital A and capital B. So how do we do that? Well, we keep in mind this expression must be on the left-hand side, must be equal to 0 for any value of UT. So how is that possible? It's only possible if the term in brackets here is equal to 0. So that when UT changes, this whole expression remains equal to 0. So when is the term in brackets here equal to 0? It's equal to 0, so you solve for capital B. That's the only variable contained in this term in brackets, and you find that capital B must be equal to this. Okay. So now once you found this value for capital B, now you get back to this equation. You plug in the value of capital B here, and you're going to have that this whole term here must be equal to 0 because this is equal to 0, right? So now this must be equal to 0. And you find the value of capital A, which is capital A must be equal to this, You could also replace by the values of capital B here if you wanted to. Okay, so now we've derived what the stock price is going to look like as a function of the model parameters and the current demand from noise traders. And if you write it down, you can find that the stock price can be decomposed into four components. The first one is the fundamental value of the risky asset. So as we argued before, so the value of the risk-free asset was 1, it was normalized to 1. And so because the risky asset is fundamentally the same, the fundamental value of the risky asset is also 1. Then there is a current demand emanating from noise traders. And so this is coming from this expression here. And so here, if noise traders demand more of the asset at any time t, that's going to drive up the stock price. Then there is the expected demand from noise traders. And this is actually the expected demand, the expected future demand from noise traders. So if you expect noise traders to keep on demanding large quantities of the asset in the future, then you expect future prices to be high, simply because noise trader demand affects the stock price here. And so if you expect future prices to be high, you are going to be willing to pay a higher price for the asset today. So that's going to drive up the price today. And finally, there is a risk premium. It is the fact that demand from noise traders makes holding the asset risky. And there's a positive supply of the risky asset, and sophisticated investors are risk averse. And so this is the risk that they will be exposed to, the variance of the future stock price at which they will liquidate their position. And so because of that, there's going to be a risk premium that's going to drive down the stock price. Okay, so there's two equilibria in this model. The second one actually is the one that we studied so far. And this can be referred to as a noise trading equilibrium. So note that there's some implicit assumption that we made is that the variance of PT plus 1 was positive. Otherwise, you cannot write this equation. But the variance of PT plus 1 being positive means that implicitly we assumed that this parameter B is positive. Okay, so we implicitly assumed that the price was sensitive to the current demand from noise traders. And we said, well, if the price is sensitive, then the price will look like this. Okay, if the price is sensitive, it's going to be sensitive in any period, and it's going to look like that. And the idea here is that unpredictable demand from noise traders, because it's unpredictable also in the future, is going to generate some risk, which is going to make sophisticated investors reluctant to bring prices back into line with fundamentals. And so that can create divergence between the asset price and its fundamental value. So as you can see here, the fundamental value of the asset is 1, but it's going to diverge because noise traders are trading and sophisticated investors are going to be unwilling to take a very large risk. And why are they unwilling to take a very large risk? Well, because they are risk averse, and because the future demand from future noise traders will make the price at which these sophisticated investors will liquidate their positions risky. Okay. And so they will not push prices all the way back into line with fundamentals. And so there's going to be a divergence between the market price of the risky asset, PT, and its fundamental value, which is 1. Okay, and so in the paper, in the original paper, Noise Trader Risk in Financial Markets, the authors push for a behavioral interpretation. They're arguing that noise traders are biased. They have the wrong beliefs about the value of the asset. But as Dimitri Vayanos and Jian Wang point out, this is only one interpretation of this model. And actually what they explain is that any demand shock, so any random demand from investors, from whom we refer to as noise traders here, is going to produce the same effects because it would make future prices unpredictable. And therefore, it's going to restrict the willingness of sophisticated investors to trade against market prices today, so to trade against noise traders today. Okay, so that's the noise trading equilibrium, in which, because you believe that noise traders will affect market prices in the future, you're going to be unwilling as a sophisticated investor to bring prices back in line with fundamentals today. And so this is a self-sustaining belief, right? Because you believe that markets will be inefficient in the future, your behavior is such that market prices are inefficient right now. Now let's move on to the other potential equilibrium in this model, which is the fundamental equilibrium, where everything is well. So as I mentioned here, to have this noise trading equilibrium in which market prices are affected by noise trading demand, we needed to assume that capital B here was strictly positive. So that this term, so we implicitly assumed that the variance of the future stock price was strictly positive. But now let's make the other assumption. Let's assume that B is equal to 0. So right now, everyone believes that the stock price doesn't actually look like this, but with B equal to 0, the stock price is actually a constant. But then it's a constant in any period. It's only equal to A in any period. But then, so if B is equal to 0, it means that the variance of the future stock price is equal to 0. So there's no risk at all. So what is the optimization problem of sophisticated investors? So let's rewrite that. So they maximize this objective function. So now there's no risk, right? So there's no variance term. So they just maximize their expected wealth next period. And so as you can see, this objective function is linear in xt. And so then the equilibrium, so the optimal value of xt is not given by an interior solution, it's given by a corner solution. Because the objective function is linear in xt, it's either going to be increasing in xt or decreasing in xt. So then the optimum is going to be the maximum possible value for xt or the lowest possible value for xt. And so what is it going to be? So there's two possible cases, right? So if capital A is greater than 1, so it means that if the price of the risky asset in any period is greater than 1, then the asset is overvalued, right? So what are sophisticated investors going to do? They're going to short as much as possible of the risky asset, and they're going to take a long position in the risk-free asset, thereby making infinite profits. The other possibility is that A could be less than 1, in which case the risky asset is undervalued in any period. So in which case, what do sophisticated investors do? Well, they borrow as much as possible against the risk-free asset, and then they take a long position. They invest all the proceeds in the risky asset, and then they make infinite profits. Okay, so that is, note that these two possibilities are inconsistent with market clearing, right? You would not get market clearing for any UT if xt were plus or minus infinity. And so the only values of A which is consistent with market clearing is that the value of the risky asset must be equal to 1. Okay. So if B equals to 0, necessarily we must have that A equal to 1. But what does this mean? This means that the price of the risky asset at any point in time will be equal to the price of the risk-free asset. So this is indeed a fundamental equilibrium in which the market price of the risky asset is always the same as the risk-free asset, which is a perfect substitute in terms of cash flows. Okay. And so what's interesting here is that fundamentally the model is the same in these two equilibria, right? The only thing that changed is the beliefs of sophisticated investors. If sophisticated investors believe that market prices will be reflective of fundamentals and of fundamentals only, meaning B is equal to 0, then they will be willing to trade by taking huge positions in such a way that they will indeed bring the market price of the risky asset back in line with its fundamental value, regardless of the demand emanating from noise traders. As they will trade against noise traders, and they would be willing to take huge positions because they are not exposed to risk. In this case, there is no risk. Now, the other possibility is when sophisticated investors believe that future market prices will diverge from their fundamental values, then they know that they will take risk by trading today. And so they would be unwilling to take sufficiently large positions that will bring market prices back in line with fundamental values. And so then market prices will diverge from their fundamental value today and in the future as well. Okay. And this is why the beliefs of investors are really crucial. And sometimes with the slightest event can trigger a change in beliefs that will in turn trigger a change in equilibrium. Sometimes this is referred to as a regime switch in financial markets. And so this emphasizes the limitations of history and statistics. Relations between variables are not constant over time. In particular, volatility is stochastic, and correlations between financial assets are not constant over time, right? So you can measure all you want. You can try to have very precise measurements. When there is a regime switch in financial markets, all these measurements based on historical data become quite meaningless. And they can become even dangerous if you really rely on them to make your decisions. And so this was illustrated time and time again. In 2008, you could read about chief financial officers in major investment banks who were really surprised. They were saying, oh, but we are observing 10 sigma events in financial markets. This should only happen once every 10 million years. And of course, I didn't understand that in this case, statistical relations between stock market variables were completely different for example, in September 2008 than they were in the past. But these people were still relying on past data to try to analyze what was happening. And this was completely useless. Likewise, you could try to measure correlations between asset prices to try to build hedges against stock market declines. But again, oftentimes when there's a crisis, these correlations are going to break down. Okay, so they're not going to be that useful anymore. These are two recent examples. You can use many other examples. So here, this is an example of the spreads on government bonds that were converging in the 90s during the introduction of the euro in Europe. But then during the Eurozone crisis, spreads started widening again. Okay, so if you were betting on the fact that spread would converge, well, your trade would be completely wrong a few years later. Likewise, if we look at the early days of the COVID-19 pandemic, and here you look at daily stock market movement fluctuations, and they were pretty mild. And then starting in February and March of 2020, you could see movement of minus 10% or plus 10% daily. Okay, so volatility was extremely different. So if you relied on previous measurements, you would be in big trouble.